What if the global financial system you trust every day is not collapsing, but unfolding exactly as designed? What if the crises, the bubbles, the debt explosions, the corporate scandals, the currency manipulations, the geopolitical tensions, all follow a predictable six-stage cycle that every major empire, every dominant corporation, and every financial market in history has repeated before its downfall? And what if the world in 2025 is already deep inside stage 3 of that same grand fraud cycle, repeating patterns that toppled entire civilizations long before anyone knew they were living through the turning point? For centuries, great powers believed they were exceptional. The Spanish Empire convinced itself its silver would last forever. Victorian financiers believed the pound was unbreakable. Wall Street in the early 2000s believed its models were flawless. Every system that entered this cycle felt safe right until it wasn't. They all shared the same blind spot: a hidden sequence of incentives that rewards manipulation, fuels moral decay, and gradually replaces productive growth with engineered illusions. And once the shift begins, it is almost impossible to reverse. Today, the signs are unmistakable. Markets move in ways that have nothing to do with fundamentals. Corporations inflate their value with accounting smoke and mirrors. Governments rely on debt expansion like oxygen. Central banks manipulate currencies like levers in a machine they no longer fully control. And through it all, powerful actors insist that everything is stable, normal, sustainable. But if you recognize the historical pattern, you see the cracks. You see how stage 3 of the grand fraud cycle transforms manipulation into structure, turning fraud not into an exception, but the operating system of the economy itself. So as you listen to this, ask yourself, have you ever felt that something about the global system simply doesn't add up anymore? That the numbers look real, but the reality feels hollow? That we are living inside a narrative designed to keep the illusion intact for as long as possible? Because what you are about to uncover may challenge everything you thought you understood about economic history and the system we live in today. Before we move forward, share your thoughts below. Have you ever noticed these patterns in your own financial life or in the global news cycle? Your comment helps shape this conversation. And while you're here, make sure to like this video and check whether you are subscribed to the channel so you do not miss the rest of this investigation into the grand fraud cycle. Now, let's continue as the deeper layers of this pattern begin to reveal themselves in ways most people never see. The roots of every fraud cycle begin long before anyone recognizes what is happening. At the start, the system is still productive, still innovative, still aligned with the real economy. Empires grow because they conquer or trade efficiently. Corporations rise because they build something of genuine value. Markets expand because savings are transformed into investment. In these early phases, manipulation is not yet a strategy. It appears only as a temporary shortcut, a minor adjustment, a small bending of rules to keep momentum alive. That is why the beginning of the cycle always feels harmless, even rational, because it emerges during periods of genuine success when confidence is high and scrutiny is low. But this is precisely where the fuse is lit. When institutions grow, they accumulate influence. When they accumulate influence, they begin to protect themselves. And when they protect themselves, they look for ways to maintain expansion, even when natural limits begin to show. A government facing slowing revenue experiments with creative accounting. A corporation under pressure to keep shareholders happy smooths out its earnings. A financial market that fears instability introduces tools that simulate stability, without actually creating it. These early manipulations do not announce themselves as fraud. They are framed as necessary adjustments, innovative mechanisms, or smart policy decisions designed to preserve growth. And because they occur during a time of optimism, almost no one questions them. The pattern becomes even more dangerous once the incentives shift. Leaders begin to realize that these adjustments work. The system does not punish them. It rewards them. A small tweak in monetary policy boosts markets. A quiet relaxation of oversight attracts capital. A subtle change in how value is reported increases investor confidence. Each shortcut offers immediate benefits and only invisible long-term costs. This is how manipulation evolves from accident to method, from improvisation to expectation. The actors involved slowly discover that the easiest path forward is not transparency, but controlled distortion. And yet at this stage, everything still looks normal from the outside. People celebrate economic growth without noticing it has become increasingly artificial. Companies report profits without acknowledging how many levers were pulled behind the scenes. Public institutions present stability without revealing how much of it relies on engineered illusions. The system continues upward, but it moves differently now, propelled less by real productivity and more by the subtle architecture of concealed support mechanisms that no one openly acknowledges. This is the quiet turning point, the moment when the foundation begins to shift even though the structure appears unchanged. And once this momentum takes hold, the system moves inevitably toward the stage where fraud stops being an occasional tool and becomes the framework that holds everything together. As the cycle advances, the system crosses a threshold where small manipulations evolve into organized methods, and these methods quietly reshape how power operates. What once looked like isolated decisions becomes a deliberate architecture of control. The elites inside the system begin to understand something crucial. They can influence outcomes not by responding to market forces, but by shaping the very environment that defines those forces. This is the stage where shortcuts become strategy, and the system learns to depend on them. It begins with information. Whoever controls information controls perception, and whoever controls perception controls behavior. Corporations refine the art of storytelling, framing losses as strategic repositioning, and debt as forward-thinking investment. Governments refine narratives around stability, insisting that temporary imbalances are signs of inevitable progress. Financial institutions master the language of complexity, turning simple risks into sophisticated products no one fully understands. Layer by layer, transparency erodes and is replaced by curated interpretations that maintain confidence even when fundamentals deteriorate. Next comes the institutionalization of manipulation. Mechanisms originally designed to prevent crises are gradually repurposed to hide them. Accounting standards become flexible enough to smooth volatility. Regulatory frameworks develop exemptions that only the largest players can access. Monetary policies shift from occasional interventions to constant support structures that ensure markets behave within acceptable boundaries. None of this appears malicious. It appears technical, administrative, even responsible. But underneath, the system is learning how to act without being constrained by its own rules. As these dynamics consolidate, power starts concentrating. The actors who understand the mechanisms accumulate influence over those who do not. Corporations with access to credit and financial engineering grow faster than those dependent on real productivity. Politicians aligned with financial interests gain more leverage than those seeking structural reform. Markets that should reflect supply and demand begin moving according to expectations shaped by a handful of dominant institutions. The system becomes predictable, not because it is healthy, but because it is increasingly managed. And this is where the cycle becomes self-reinforcing. Once manipulation proves effective, the pressure to rely on it intensifies. Investors expect stability, even when conditions are unstable. Governments fear the political cost of allowing natural corrections. Corporations become dependent on inflated valuations to maintain access to capital. Every participant knows something is off, yet each one is incentivized to continue because stopping now would expose how fragile everything has become. By this point, the system is no longer responding to reality. It is responding to the maintenance of appearance. Growth must appear steady even when it slows. Stability must appear solid even as risks accumulate. Confidence must appear strong even as internal structures weaken. This is the defining feature of the stage ahead. The moment when the architecture of manipulation becomes the operating system itself, setting the stage for the next shift where the facade hardens into full structural dependence. By the time a system reaches stage 3, what once looked like discrete manipulations has evolved into an invisible framework that holds the entire structure together. Fraud is no longer an aberration. It becomes routine, normalized, even expected. It is woven into the monetary system, embedded in corporate valuation models, mirrored in political incentives, and reinforced through media narratives that keep the illusion of order intact. This is the moment when the system stops pretending and begins functioning on engineered reality rather than genuine fundamentals. In this stage, money itself becomes abstract. It is no longer a representation of value, but a tool used to manufacture the appearance of stability. Central banks inject liquidity not to stimulate growth, but to prevent markets from revealing their true condition. Governments issue debt with no intention of repaying it, confident that the system has become too interdependent to question the premise. Corporations rely on financial engineering to create the image of expansion, even when operations stagnate. At every level, numbers replace substance, projections replace production, and confidence replaces accountability. Markets follow similar patterns. Prices respond less to supply and demand and more to signals generated by institutions that have mastered the mechanics of perception. A single statement from a central bank can move trillions. A subtle change in accounting language can inflate earnings across entire sectors. A well-orchestrated narrative can transform weak data into a bullish indicator. The system rewards those who understand these dynamics, not for producing value, but for mastering the choreography of illusion. Yet the most important shift occurs quietly. Participants adapt. Once fraud becomes structural, people stop questioning it. Investors begin treating artificial stability as normal. Corporations assume access to cheap credit is permanent. Governments build budgets around the expectation that debt can grow endlessly without consequence. Even individuals contribute to the cycle by basing their financial expectations on inflated asset prices and unsustainable promises. The illusion becomes a shared reality, reinforced by the collective need to believe the system will keep functioning. But under this surface, pressure builds. Each manipulation creates a new dependency. Each dependency magnifies the consequences of failure. Every guarantee, every intervention, every distortion adds weight to a structure designed to hide rather than resolve its internal weaknesses. And even though the system still looks stable, its resilience is quietly eroding, setting the stage for the first visible ruptures that will test the narrative holding everything together. Before we move on, tell me what you think about this stage. Have you noticed any part of the economy that seems to rely more on appearance than substance? Share your thoughts in the comments. Your perspective adds depth to this investigation and helps us understand how people experience these shifts from the inside. As the structural illusion solidifies, something subtle but critical begins to take place beneath the surface. Populations, companies, and even sovereign states start adjusting their behavior to fit the logic of a system that no longer functions on genuine value creation. This adaptation is gradual, almost invisible at first, yet it transforms every level of economic activity into a coordinated response to an environment shaped by distortion rather than reality. Individuals feel it long before they can articulate it. They notice that prices rise faster than wages, that saving seems pointless, that every path to financial security appears to depend on speculation rather than stability. Instead of questioning the system, people adapt. They chase asset bubbles because waiting for fundamentals to align has become a losing strategy. They rely on credit because the cost of living grows faster than their purchasing power. They accept financial fragility as normal because the entire structure around them reinforces the message that this is simply how modern economies work. Corporations undergo a similar shift. Once the incentives reward manipulation more than productivity, companies restructure themselves around financial performance rather than operational strength. Balance sheets become tools for creating impressions. Capital is allocated not to innovation, but to activities that generate immediate numerical impact. Entire industries evolve to thrive not by producing value, but by managing perceptions of value. And because the market rewards this behavior, firms that resist the trend risk being left behind, not because their products are inferior, but because they refuse to participate in the hidden game everyone else is playing. Governments, too, adapt to the new landscape. Policy becomes reactive, shaped not by long-term planning, but by the need to preserve confidence in systems that have grown too fragile to withstand transparency. Instead of addressing structural weaknesses, authorities focus on short-term fixes, injecting liquidity, expanding credit, and presenting predictable outcomes that reassure markets. Sovereign states might recognize the underlying fragility, Yet they continue reinforcing the facade because the political cost of revealing the truth is greater than the cost of maintaining the illusion. Even the international system adjusts. Countries align their economic strategies around expectations set by dominant powers, financial markets, and reserve currencies whose stability depends less on fundamentals and more on orchestrated belief. Instead of diversifying risk, nations accumulate exposure to the same mechanisms that underpin global liquidity. They adapt not because they trust the system, but because they fear the consequences of stepping outside it. In these conditions, normalization becomes the most powerful force of all. People get used to living inside a system that they know is distorted, but they stop imagining alternatives. Companies optimize their strategies around incentives they privately acknowledge as unsustainable. States participate in global structures they suspect will eventually fracture, but they continue because the illusion still functions well enough to avoid immediate crisis. And without recognizing it, the entire world drifts into a coordinated state of quiet dependence, preparing the ground for the period when pressure reveals the limits of adaptation. As the system advances through this phase of quiet adaptation, tension begins accumulating in places most people never look. At first, it appears in minor anomalies that seem unrelated. A sudden liquidity freeze in a market that was considered safe, an unexpected bankruptcy of a company assumed to be stable, a flash crash that resolves as quickly as it emerged. These events are dismissed as isolated incidents, statistical outliers, temporary distortions that do not reflect the underlying strength of the system. But in reality, they are signals, early symptoms of a structure that has started to strain under the weight of its own design. Behind the scenes, fragility expands. Institutions that rely on endless credit begin to feel the pressure when even small disruptions challenge their assumptions. Banks tighten lending standards not because they fear recession, but because they sense that the system itself is no longer predictable. Corporations quietly revise their internal forecasts, preparing for outcomes they cannot acknowledge publicly. Governments increase reliance on monetary intervention, not to stimulate growth, but to prevent instability from revealing itself too quickly. These micro-adjustments accumulate into a silent architecture of caution, a hesitation that permeates every layer of the economy. In markets, volatility becomes more frequent. Prices swing in ways that cannot be explained by fundamentals, revealing the influence of invisible forces. Risk models begin failing because they were calibrated for a world that no longer exists. Financial instruments that once behaved predictably react in ways that expose hidden dependencies, correlations, and vulnerabilities. Traders notice it first, analysts follow. But by the time the public becomes aware, the process is already well advanced, shaped by dynamics that have been building for years. Meanwhile, ordinary people experience these tensions in more personal ways. Jobs become less secure, even when unemployment appears low. Debt burdens grow heavier, even when interest rates seem stable. Cost of living pressures intensify even when official inflation metrics suggest moderation. These contradictions create confusion, a sense that something is fundamentally out of alignment. Yet because the broader system still presents an image of stability, most people assume the discrepancies are individual rather than systemic. At the geopolitical level, competition increases as nations recognize the shifting balance beneath the global economy. Strategic alliances transform, economic blocs consolidate, countries begin stockpiling resources, diversifying currency, reserves, and preparing for scenarios they cannot publicly admit are possible. Tensions flare in trade disputes, sanctions, and regional conflicts that appear political, but are deeply rooted in economic insecurity. These events are not random. They are manifestations of a global system approaching the limits of its ability to absorb distortion. Still, nothing appears broken enough to trigger alarm. The machine keeps running. The illusion still holds, but the pressure is no longer contained. It concentrates in choke points, in fragile institutions, in leverage that has grown too large, in expectations that cannot be met. The system continues forward, yet every step brings it closer to the moment when the first visible rupture will force the illusion to confront reality. When the accumulated tension becomes too large to conceal, the first visible ruptures begin to appear. They rarely look catastrophic at first. In fact, they often present themselves as manageable disruptions, the kind of events officials describe as temporary setbacks or market overreactions. But beneath these calm explanations lies a deeper truth. Stage 3 is ending, and the system is entering a phase where reality begins pushing back against the illusion that held everything together. The earliest ruptures are psychological. A major institution reveals accounting irregularities. A trusted corporation quietly restates earnings. A government admits that previous forecasts were unrealistic. These incidents may not seem connected, yet each one chips away at the belief that the system is functioning as claimed. Confidence does not collapse all at once. It erodes grain by grain, as people begin sensing that certain stories no longer match observable outcomes. Then come the narrative fractures. Official explanations grow inconsistent. Authorities revise their own statements. Analysts contradict one another. Metrics are adjusted. Definitions changed. Benchmarks reinterpreted. You start seeing two parallel versions of reality, one presented in official reports and another reflected in lived experience. When this divergence widens, the public begins noticing. The illusion starts losing its coherence because maintaining it requires every pillar of the system to align perfectly, and that alignment becomes harder to sustain as pressures intensify. Markets typically reveal the next cracks. Liquidity evaporates unexpectedly in assets that were supposed to be safe. Investors rush into havens not because of immediate danger, but because they sense the underlying structure shifting. Small corrections become outsized moves. Financial instruments that were engineered to maintain stability begin malfunctioning under stress. These disruptions expose the layers of leverage, interdependence, and hidden risk that accumulated quietly during the previous stages. Governments, too, begin showing signs of strain. Policy responses grow more extreme, more reactive, more desperate to preserve appearances. Emergency measures become routine policy tools. Quiet interventions become frequent, then necessary, then expected. Officials insist everything is under control, yet their actions reveal the opposite. When the guardians of the system behave as if they are containing a threat, even while insisting none exists, people start paying attention, and eventually, the ruptures reach geopolitics. Nations begin challenging old assumptions. Economies shift alliances, change reserve strategies, and hedge against outcomes they previously dismissed as unthinkable. These moves are small at first, but each represents a vote of no confidence in the stability of the global architecture. Once enough states begin acting defensively, the coordinated facade of international stability loses its grip, and the fractures become visible across borders. These ruptures do not signal collapse. They signal exposure. They show where the system can no longer maintain its mask without revealing the contradictions it has accumulated. And as these cracks widen, the shift into the next phase becomes unavoidable, driven by forces that no institution can fully contain. Before we continue, I want to hear from you. Which recent events made you feel that official narratives and real-world outcomes no longer align? Share your thoughts in the comments. Your perspective adds depth to this unfolding story and helps reveal how people perceive these ruptures from the inside. History offers a mirror for the present, and, when you study previous collapses with clarity, a striking realization emerges. Every fraud-based economic system, regardless of era, culture, or technology, breaks down in almost the same way. The actors change, the tools evolve, the narratives adapt, but the underlying sequence remains constant. The pressures that build, the behaviors that emerge, the fractures that spread, all follow a rhythm so persistent that the past becomes a diagnostic instrument for understanding the future. Ancient empires displayed these patterns long before modern finance existed. The Roman monetary system collapsed after decades of currency debasement, disguised as prudent fiscal management. The Ming dynasty unraveled when corruption hollowed out institutions that appeared stable on the surface. The Ottoman Empire weakened over centuries of bureaucratic manipulation and financial overextension. Each system entered a phase where appearances mattered more than fundamentals, where elites protected illusions to preserve their authority, and where people adapted to distortions rather than confronting them. The end never came suddenly. It came gradually, then all at once, after decades of structural denial. More recent systems expose the same sequence with even greater clarity. The Dutch tulip bubble, the South Sea Company, and the Mississippi Scheme are often framed as isolated manias, but beneath the speculation was a deeper pattern. Governance failures, information asymmetry, and the normalization of manipulation. When trust finally broke, markets collapsed with a violence that reflected how deeply fraud had been embedded into the structure. The 19th and 20th centuries continued the pattern. The collapse of the British Empire was not caused solely by war, but by the long-term effects of financial engineering masquerading as sustainable policy. The Soviet Union's demise was not just political decay, but a predictable outcome of a system that replaced productivity, with narrative-driven reporting and concealed failure behind forced illusion. Even the Great Depression followed years of artificial stability, opaque financial products, excessive leverage, and a collective belief that the system had transcended risk. Across all these cases, a common thread emerges. Once fraud becomes structural, collapse becomes predictable. When a system relies on distortions to sustain itself, each new manipulation weakens its ability to correct course. Institutions lose the capacity to self-regulate. Leaders become captives of their own narratives. Citizens sense contradiction but lack the power to reverse it. By the time visible ruptures appear, the internal damage has already passed the point of repair. These historical cycles also reveal something crucial about timing. The shift from stage 3 to the stages that follow does not occur because of a single shock. It occurs because long-hidden contradictions suddenly become impossible to conceal. Public confidence, once maintained through carefully crafted narratives, begins to fracture. Markets, once supported by engineered stability, start reacting to real conditions rather than manufactured signals. States, once aligned through shared assumptions, shift into self-preservation mode. History shows that when these elements converge, systems do not drift gently into change. They pivot sharply, driven by forces no single institution can control. And this is the precedent that frames the world today, offering a lens through which the current stage can be understood not as an anomaly, but as the expected trajectory of a cycle that has played out repeatedly across civilizations. Now, let's bring this pattern into the present. In 2025, the global geoeconomic landscape is a complex web of interdependence, debt, and engineered confidence. Stage 3 of the grand fraud cycle is in full effect, and its fingerprints are everywhere. Financial markets, corporate networks, and sovereign debt. Structures all operate according to the rules established by historical precedents, yet amplified by modern technology, instantaneous information, and globalized capital flows. The result is a system that appears robust while hiding vulnerabilities that are larger and more interconnected than ever before. Corporations, for instance, are no longer evaluated solely on productivity or innovation. Instead, their valuations depend on perceptions, narrative alignment, and the ability to manipulate metrics that influence investor behavior. Revenue recognition, intangible assets, share buybacks, and creative reporting have become part of the toolkit. These tools allow companies to project growth even when operational performance is stagnant. Analysts, regulators, and media often accept these projections because challenging them requires admitting that the system itself relies on these distortions to function. Governments, on the other hand, depend heavily on debt instruments, monetary intervention, and fiscal signaling to maintain an image of stability. Central banks manipulate interest rates and liquidity levels not just to guide economic growth, but to prevent structural weaknesses from becoming visible. Currency value, which historically reflected production and trade, now represents the credibility of the system's architects. Sovereign bonds are purchased and circulated globally, creating a network where debt is simultaneously the tool of control and the illusion of solvency. Once the perception falters, systemic confidence collapses almost instantly. Markets amplify these distortions. Every ripple of policy, every corporate disclosure, every geopolitical statement is interpreted through the lens of maintaining or undermining confidence. Price movements often respond less to fundamentals and more to the orchestrated narratives surrounding stability and growth. traders, investors, and institutions adjust their behavior accordingly, reinforcing the cycle. The system has become highly sensitive to perception, a fragile equilibrium where even minor signals can trigger cascading effects. Globally, nations are bound together in this artificial architecture. The flow of capital, the alignment of monetary policies, and the interlocking nature of trade dependencies make it difficult for any state to act independently. Attempts to break from the collective reliance on the illusion are met with market penalties, credit restrictions, or political pressure. As a result, governments adapt to sustain the system rather than reform it, embedding structural reliance on distortion and manipulation even deeper. At this point, Stage 3 has transformed the global economy into a finely tuned machine of engineered stability, where appearances govern behavior, and real resilience has been replaced by orchestrated compliance. The world continues to move forward, but every transaction, every investment, and every policy decision is now contingent on a system that cannot endure the revelation of its own fragility. The consequences of disruption, when they arrive, will be magnified because the dependencies are more extensive and the distortions more deeply embedded than in any prior historical cycle. The final stage of this cycle is approaching, and while Stage 3 has shaped the system, the transition toward collapse is inevitable if historical patterns hold. What we are witnessing now is a global economy deeply reliant on illusions. Corporate, narratives, government interventions, financial engineering, all sustained by collective belief rather than underlying fundamentals. And when these constructs finally reach their limits, the shift will not be gradual. The rupture will be swift, undeniable, and transformative, affecting every layer of society, every market, and every institution. At this point, it becomes critical to recognize the mechanisms that have brought us here. Debt that can never be repaid, currencies whose value is maintained through perception, markets that respond to narratives more than reality, and political systems that prioritize image over substance. All these factors interact in ways that create a fragile equilibrium, stable enough to continue operating for now, but unstable enough that a single shock can ripple globally. And because history repeats itself, the actors and institutions that have relied on these distortions will find themselves unprepared, just as every empire, every financial system, every market cycle has been unprepared in the past. The lesson, however, is not despair. It is awareness. Understanding the cycle allows us to anticipate, to question, to observe where the system depends on illusion rather than substance. Every financial decision, every policy intervention, every market trend can be analyzed through the lens of the grand fraud cycle. By recognizing Stage 3 for what it is, you gain insight into the vulnerabilities that most overlook, the pressures, building quietly beneath the surface, and the early signs that precede systemic failure. If you have followed this journey to the end, take a moment to reflect and engage. Leave a comment below with a phrase like, "I'm with you to the end," or "This message was for me," sharing what insights or revelations stood out to you the most. Your thoughts add depth to this discussion and help us all interpret the patterns unfolding around us. While you do that, make sure to hit the like button if you found this content valuable, and check that you are subscribed to the channel to continue exploring these cycles with us. There's another video here that complements this analysis, diving even deeper into the mechanisms behind global financial manipulations. So click and continue the journey. By staying aware, by observing, and by engaging, you position yourself not as a passive participant, but as a conscious observer of the forces shaping our world. The grand fraud cycle does not have to catch you by surprise. The knowledge, the understanding, and the connections you build today are the tools to navigate the challenges of tomorrow, keeping you informed and prepared as the system continues to unfold.